Today's banking crisis is the third trillion-dollar-plus U.S.-caused financial meltdown in the last 20 years. Each one of these financial disasters came into being through the same basic mechanism, the fraudulent overvaluing of financial assets by Wall Street with a wink and a nod, and sometimes a lot more, from the White House and Congress. The fraudulently valued assets stimulate the economy, impart the illusion of health, and then inevitably the fraud goes too far and the whole house of cards comes painfully crashing down to earth. The Insider Exclusive will examine how the scheme works. It's not complicated at all. You take near worthless pieces of paper and declare them to be good as gold. Then you create as many junk bonds and internet startup stocks as you get and sell them as fast as you can. In the case of the current crisis, the instrument of fraud was the so-called subprime mortgages. Wall Street saw a golden opportunity to get rich. Wall Street said, if we take lots of these mortgages and assemble them into large pools and then slice and dice the pools in various ways, we can sell the slices to the banks and other investors as AAA paper. Sounds crazy, doesn't it? The crisis this fraud has created is exponentially bigger than the S&L and tech bubble combined. It's not going to be resolved by a quick patch-up and will likely have the same impact on the current generation that the Depression of the 1930s had on its parents, grandparents, and great-grandparents. Hi, I'm Steve Murphy, and this is the Insider Exclusive. Today, we're going inside Wall Street's engine of doom and its financial meltdown. And we're featuring Andrew Entwistle, managing partner of the law firm of Entwistle and Capucci, Norman Vonnegut, one of Wall Street's insiders, and Bill Black, former S&L regulator and best-selling author of The Best Way to Rob a Bank is to Own One. Stay tuned. I want to welcome to the show Andrew Entwistle. Welcome to the show.
It's nice to see you again, Steve.
Good to see you. In the last 9 months, we've had one of the worst financial meltdowns, not only in the United States, but also globally. What happened? What's happening here?
Well, there's been a lot of speculation and talk about how this all came to be. Some people blame it on government regulation or the lack of government regulation, government deregulation. Looking back, I think that's all part of it.
Yeah.
But the real driver, here is the same as it's been in prior fiscal crises,
Greed.
and that's greed.
Yeah.
Just pure and simple. And here, of course, you had investment bankers who were trying to compete with deregulated central banks, major institutions like Citigroup and Bank of America and others. And in order to do that, they asked for the relaxation of certain, requirements. They got it, and they were off to the races.
You have a lot of bright people in government, and you have a lot of people who can foresee the fact that greed is one of those human characteristics that's going to live on forever. Why don't they see, or why don't they put into place some measures where there's checks and balances so these things don't happen?
Well, there's kind of an ebb and a flow to that.
Mm-hmm.
We had the savings and loan crisis, and we got some regulation. Mm-hmm. We had the first, obviously, going all the way back to the Great Depression. We had that. We had Glass-Steagall, and we had other regulation that came from that. When long-term capital management went down the tubes a few years ago, we had some regulation that came out of that. And of course, when Enron, failed and WorldCom failed, not that long ago, we had, we had Sarbanes-Oxley come out of that. Well, what we saw was, a few years after the dust had settled with Enron and WorldCom and Global and those companies, you had this sort of backlash that came back. The pendulum started to swing the other way. There was a lot of talk about, deregulation. There was a lot of talk about, what we do with Sarbanes, can we relax it, et cetera. And all that comes from the lobbying by the financial industries. Some of it is sort of public. Sarbanes lobbying attracts public attention. But a lot of it happened very much behind the scenes. Some of the deregulation that happened related to the investment banks and what they could and couldn't do in terms of CDOs and the like, and what could happen or couldn't happen with CDSs. Was some legislation which amounted to deregulation that happened there that the public was wholly unaware of when it happened, and so it was an easy way for politicians to curry favor, if you will, with the financial community, put campaign dollars in their pockets,
Sure.
And yet do something that the general public was wholly unaware of, all under the theory that, well, we need this to be competitive. We need these things to be able to advance ourselves. If we don't sell this here, companies can go buy it overseas, and so we need to be on a footing with what's happening in other markets. Those types of arguments are arguments that, regulators in Washington, often from Congress people, find very attractive in an environment where the pendulum is swinging away from regulation. Now we're at a point where people have seen this crisis, and yet it's gotten to a depth where we don't see where now it's going to swing back from a regulatory standpoint. We see the SEC saying, well, we need more fraud investigators. We need more people to do those things, and certainly they do. But it's not just that they need them. It's that they need to be able to attract really talented people, experienced people, and retain them in the public sector. And that's extraordinarily difficult to do.
We've had these financial wizards, if you will, on Wall Street who design products that you mentioned, CDOs, collateralized debt obligations, CDSs, credit default swaps, that when you really look into them, they're almost like smoke and mirrors. And they're based on the premise, and which was the premise over the last, 8 years or so, that housing prices would continue to increase, never decrease, correct?
Well, I think that's true for the most part.
Okay, but this is so outlandish to think that way. And some of the agencies that I've looked at, like for example, the rating agencies, when they were giving their AAA ratings on junk, it was junk, and they knew it. Are they culpable in the overall scheme of legal suits?
We think they are. I don't think there's any question that really there had to be collective conduct here in order for all this to happen, because there's such a symbiotic relationship and interrelationship between the different pieces. The general public hears about what happened in subprime. They think, well, the lender on the street who's lending to someone who lives, in the ghetto or in low-income housing. That's not really what was happening here at all. Certainly, many loans were made to people, who in that category who couldn't afford them.
Yes.
But an equal number of loans were made, if not a greater number, were made to folks who couldn't afford their loans, who were far higher up the socioeconomic strata, than folks who were scraping by or just, barely getting by at minimum wage. And the driver for that, really was Wall Street. It started with Bear Stearns and those partnerships. What they figured out was we can make a lot of money by repackaging debt for all these mortgage lenders.
Which were basically pools of mortgages that varied in their credit ratings, if you want to look at individual ones, which the rating agencies, some way, somehow, were able to put AAA ratings on a lot of this junk and sell it off, and they knew it. Sell it off to pension funds, many of whom you represent, that absorbed this, invested their money in because they had a criteria they couldn't invest in anything less than a AAA, security, and now are sitting on huge losses.
Well, that's right. And really what was happening was by repackaging mortgage debt and other debt. It's not just mortgage debt, but it was all different types of loans, credit cards and personal loans and all kinds of things that were done, commercial loans. And so what would happen is they'd go to banks that had capital reserve limitations. And, it might be Citi, whomever, who had a limit on how much they could lend in total. And that was sort of a check and a balance, as you talked about before, on how much or how great the risk of failure is. Then the change from that was that they would say, fine, we're going to take that whole basket or portfolio of debt that you have.
Buy it from them.
We're going to buy it from you. We're going to allow you to move it off balance sheet into a new entity. The same kinds of things that was happening back with Enron
Yes.
and WorldCom and others.
Yes.
Essentially, they created off-balance sheet entities, and these entities issued securities, CDOs or other mortgage-backed securities, to fund the debt. So they sold those securities, and they took the money from it, and they gave it to the banks. So the banks could relend it. At the same time, the investment bankers made money by setting up and running these off-balance sheet entities. They made money by selling these securities, and then they made money often by doing other things and servicing them, et cetera.
And millions of dollars.
Billions of dollars.
Yes.
Billions of dollars were made in profits by the investment banking community in particular in that piece. Meanwhile, all of the banks, what we call the primary lenders or loan originators, are also making billions of dollars because they're selling not just mortgages one time, but 2, 3, 4, 5 times, without, with complete and utter disregard for the fact that if I have a 4% default rate when I have, when I sell my portfolio once, right, my lending portfolio once, when I do it 3, 4, 5 times, now I've got effectively a 20% effective default rate.
Yes.
And that's where the weight came back to crush folks. And it was really this abject, recklessness
Yes.
that permeated everything. And why did people do that? It was greed. And it couldn't have been done without the ratings agencies.
Yes.
It couldn't have been done without the repackagers. It couldn't have been done without the investment banks. And it couldn't have been done without the wholesale lenders. Everybody acted in concert to sort of fund this very cyclical, symbiotic relationship. And folks are starting to ask questions of, well, why would a ratings agency do this? Well, because they made 10 or 15 times the fee on rating this type of debt that they did for issuing ratings on other types of securities.
Yeah, they had some of their best years.
They had their very best years.
This interconnection between the lack of government regulation, the lack of oversight, and the relationship with the banking industry is something that our next guest knows oh too well, and that's Bill Black, and we're going to bring him on in a minute. He's a former S&L regulator, and he's written a book called The Best Way to Rob a Bank is to Own One. So let's bring him on right now. I want to welcome Bill Black. Welcome to the show, Bill.
Thank you.
You wrote a great book, which is The Best Way to Rob a Bank is to Own One. Tell us a little bit about that book.
Well, that book is about what causes the largest property losses in the world, and it's a particular kind of fraud. We call it control fraud in criminology, that's led by the people that control seemingly legitimate corporations.
And control fraud meaning it's systemic, correct? Within a corporation, within an organization, where the top dog is actually controlling all the fraud that's happening in that company, right?
Yes, but it's also systemic in the sense that if you create the wrong environment, you'll get many of these frauds at the same time. And when you do, you'll produce housing bubbles,
Yes.
And you'll produce economic crisis.
Now, you are just not an author. You were an S&L regulator before, and if my memory serves me correct, you are the one that called to the attention of the Keating Five, Charles Keating and the 5 senators he supposedly had in his back pocket, right?
Yes, I took the notes of that meeting, and that is one of the areas where I'm sort of a serial whistleblower, and testified in the Senate ethics investigation of the 5 senators.
What does it say to you about you keep bringing out this attention of these frauds and bringing them out to the public, and nothing seems to get done about it? There's a new twist on a fraud, and it continues over and over again. What's it say to you about what the government is or isn't doing?
Well, there was an era when something was done. We got 1,000 felony convictions of senior insiders. That's the most successful white-collar prosecution effort in history.
Out of the S&L crisis.
Out of the savings and loan crisis. Now, you're right, those lessons got lost, and we've had to relearn them very, very painfully.
Mm-hmm. We see now, I think when I saw you on Bill Moyers, I believe that you mentioned you think there's a cover-up going on right now with the bailout. Tell us a little bit about your thoughts on that.
Well, that was also true in the early stages of the savings and loan crisis. When the insurance fund is massively insolvent and people don't want to spend more taxpayer dollars, that's very unattractive to politicians, the siren song is always do nothing. Just lie about the asset quality and maybe it'll all get better. That produced much bigger losses in the savings and loan crisis, and the same thing is happening now. We've actually, in this case, gimmicked the accounting rules so that banks and other entities don't have to report their losses honestly, and that's going to make for a much, much more expensive crisis.
You've said this financial implosion, if you will, is bigger than the combined S&L crisis and the internet bubble crisis. Do you see the United States government right now going into a period of stagnation or stagflation as Japan did in the early 90s?
Yes, we see both that. In Japan's policy was to cover up the banking losses.
Yeah.
The result was a series of rolling recessions. They're now on about their fifth recession. They call it the last decade, but it's now 2 lost decades of doing this. And I think the other element that you're seeing in the United States is the rise of crony capitalism of the kind that caused so much damage in the Southeast Asian crisis.
Right. Andrew, you are not a big fan of the bailout, are you?
No, I'm not. And I think, for some of the reasons that Bill's alluded to, one, of course, is that, I don't think we should ever mortgage our children's future to recover from the mistakes we make as a generation or the generation before us. And I think there were real lessons to be learned that we haven't paid attention to. One is the Japan crisis. Another is what happened even, as we recovered from the Great Depression. And a lot has been written, and I think appropriately so, that this notion that if you dump a lot of money into the economy, that you don't get the return on it that folks used to think you do. You're taking money out of the economy in taxes to put money back in. That's just doesn't get you any greater return. The notion that the federal government is better able to make investment returns than private industry is just so wrong-headed as to defy belief. But the second piece of that, of course, is why would you ever take fresh money and give it to the very same folks that put you in that predicament to begin with, one, and two, to do it in a circumstance where you haven't changed the playing field appropriately. We still have the same regulatory structure that was in place, effectively at the time that this crisis was created and grew. There's nothing right now that says, in place that would stop it from happening again today. If lenders started lending again and we started again this secondary marketplace that was really the driver or the draw of all of this. And so until you fix the regulatory structure and take your medicine, and as Bill said, there's a tremendous overvaluation or lack of transparency. Those are the things that we should have attacked, when the crisis first occurred. Obtain complete transparency, take our medicine, and if it means that some large institutions are going to fail, hey, let's take a step back. Let's separate the lending, right? These sort of financial pieces from the banking piece. Protect the folks, the depositors, but everyone else needs to take their medicine. And unfortunately, what's now happening is that we see this tremendous uncertainty. We just saw today in the papers, that the stress test results are out. Yeah. And to no one's great surprise, more money is going to be needed at some of the highest levels. And the question is, where does that money come from?
Bill, stress tests. Do you have any belief that it's a valid test?
I think it's every bit as valid as the last time we used them, which was by legislation. We mandated it 10 years ago for Freddie Mac and Fannie Mae.
And where are they today?
They're destroyed. But they passed all the stress tests
So
every
you see
step
the
of the way.
stock market going up today because it appears that the truth has been revealed. But has it really?
The stock market went up today not because truth was revealed, but because the Treasury went weak as we expected it. And as long as there aren't going to be any real stress tests, then you're into good old PPIP,
Right.
which is their acronym for their latest bailout. And PPIP is so incredibly over the top a subsidy to the banking industry that it's going to cause very substantial rises in stock prices.
That's a good subject for another show that we're going to do. And I want to thank you very much for being on this program. Stick around. We're going to do another show. I'm very pleased to have with us Norman Vonnegut, who's a Wall Street insider and has written a new book called The Producer. Welcome to the show.
Top producer. Thanks,
Top
Steve.
producer.
It's nice to be here.
You've observed Wall Street and the financial engineering that a lot of these big, supposedly geniuses were inventing so that everybody could make money. We've had the biggest financial catastrophe in what? In the history of the United States occur just now. What are your thoughts on the bailout, for example, and what Wall Street should be doing now and regulations that should be put in place so these things may not happen again?
Right. The number one thing that I think the government should do is to separate the money management decisions from financial reporting. Transparency on Wall Street is a big deal. All too often, investors don't understand what they're buying out there. One of the things I've done in my blog, acrimony.com, is really pushed to make sure investors can articulate what their money managers are doing. If your money manager says it's complicated, or it's proprietary, that's a problem. What we really need are investors who can talk about the way their money is being managed. And I think that's the wave of regulation, is to make sure there are two sets of financial statements, one from the money managers, one from a separate custodial bank that has no relation to the money managers whatsoever.
In this current bailout, what are your opinions of the relationship between the government and Wall Street as it stands today?
We're still in the early innings.
Yeah.
Who knows what direction that's going on. My real focus is how the individuals can be protected and what to do for them.
And you bring this out in your blog quite a bit, don't you?
That's right. If you visit my site, you'll see 10 ways to avoid financial fraud or to spot it. And I think some of the lessons there are indicative of the bigger problems. Again, back to transparency. What are you hearing from your money managers? What are they telling you? Mm-hmm. Make sure you can articulate it.
Andrew has brought up a very good point. We've seen these catastrophes happen over and over again, and we sum it up with one word: greed. But there is a direct relationship between what government should be doing and the fact that a lot of lobbyists or organizations that have lobbyists spend money with the politicians, legislators, politicians, synonymous, and things don't get done, right, Andrew?
Well, that's one of the big problems. It's very hard for investor-oriented organizations like the Council of Institutional Investors, or NAPA, or those types of organizations who are focused on, transparency issues, the kinds of issues that Norb's talking about or that Bill talked about, and protecting investors. Mm-hmm. They don't have the resources to compete with even a single one of these financial houses in terms of, lobbying power and money to devote to lobbyists, et cetera. And nor are they able to match them in terms of hitting all of the different pressure points. Yeah. In terms of regulation or deregulation, or back to Norm's big point, transparency. And that's got to transcend, I think, the individual investor, which I think is important at a baseline in terms of how they deal with their money manager.
Yes.
But it's also got to come from the very top down. whether it's the SEC or the Financial Accounting Standards Board, or other legislation, has got to require wholesale transparency on behalf of, companies that are publicly traded, other types of investments, whether we're talking about corporate debt, whether we're talking about CDOs or mortgage-backed securities, whether we're talking about hedge fund-related investments, anything that's going to be offered to the public as opposed to private transactions, where people are going to be looking at this from a larger sense, or at the back end looking for some bailout from the government. We ought to have transparency from that end, and not for nothing, but we ought to have transparency now in terms of where the taxpayers' dollars are going, how it's being used, and what this bailout means in terms of the future.
Right. In the overall perspective of things, you only can regulate behavior so far. We have also had a crisis, a moral bankruptcy, morality bankruptcy, where people at the top were well aware that things might fail, probably would fail, chose to do nothing, even if they were within the boundaries of the law. And I think that has to be addressed too, doesn't it?
Well, it really does. As Norb's alluded to, as Bill has alluded to, you can't have a systemic failure like we had here without collective misconduct.
Yes.
And from the very top of the ratings agencies, the repackagers, all of the folks involved in this sort of cycle, the circle.
Yes.
Every single one of them, had, a very good, solid understanding, of what the risk of failure was here.
Yes.
And they just recklessly disregarded it. They had an abject lack of concern for what the real risk of loss was, what the real risk of failure was, not just to the companies that they were involved with, but also, to the economy as a whole. And that's what we're suffering from now.
Well, this has been an eye-opener, I think, for everybody who's been watching these shows, and I want to thank both of you for being on the program. Would you hand out your website and how folks can get a hold of you, Andrew?
Well, you can find us at entwistle-law.com.
Okay.
That's the easiest way, and the rest of our contact information is all there.
And there's a lot of relevant information about all of these financial scams and that sort of thing, where people can protect themselves, correct?
Well, there's a lot of very solid information there,
Okay.
both from the investor standpoint, but also, from the general standpoint.
And Norb, how can people read more about you?
Go to my personal website, my author website, normvonnegut.com, and read what I have to say about financial services on acrimony.com. And by the way, there are plenty of good people on Wall Street still.
There's no question about that.
Yeah, it's only the bad guys that makes the news, right?
That's always the case.
Thanks for being on the program. Thanks for watching. You can get more information about our guest and the issues at www.insiderexclusive.tv.